Stephen, welcome to the show.
Thanks, Casey.
I'm excited about this conversation. We're not going to be talking about sustainable building, but we're going to be talking about something else that excites me and that has also been very painful for me in the past. And that is really like business, and more specifically, getting into the financial part of business and understanding it, right? And obviously we can't get through it all in, 30 or 40 minutes, however long we end up talking here. There's a lot to discuss, but you are a wealth of knowledge, and I'm sure we're going to get a lot out of you. So thanks again for being on the show. I'm excited for this.
My pleasure.
So before we really get into it, maybe let's just share a little bit about your background and how you got to what you're doing now, and specifically working with project-oriented businesses. Sure. And then people can get an understanding of where you're coming from.
Sure. GrowthForce is a outsourced accounting department for companies that use QuickBooks, Xero, or NetSuite. And what we do is we specialize in helping solve the major pain that people have, which is they're not getting actionable financial intelligence at their fingertips. They're frustrated because they're not making enough profit for the amount of work that they do. And they worry about whether they've got a single point of failure with a trusted bookkeeper, office manager, someone who has the title controller, but doesn't have an accounting degree and isn't quite sure how to advise the owner on what decisions do you have to make to drive profits. And so, that's our unique value proposition. You got a 3-person dedicated bookkeeper, accountant, controller, but we're called GrowthForce because we want to help you grow your bottom line. And, you talked about the sustainable builder. We talk about the sustainable business, focusing on profits, because it's not how much you earn, it's how much you keep.
Yeah, and I think that's a really key insight too, is like it's so easy to get caught up in the top line and sales and everything that we were talking about before we were recording, right? And then you realize at the end of the month or at the end of the year, it's too late. There is nothing left, right? And I think it's really tough for small businesses too, who maybe it's just like an owner operator and with a few team members, right? What size of companies are you working with for the most part?
We typically look at 2 to 20 million in revenue. So they're large enough to be past that, okay, I got a real business here and I can see everything in my office and I know what everybody's doing and I know every job. And you get past that point where you need to start trusting people and having data to be able to make decisions. We all make decisions based on our gut, your emotions, right? And I'm not suggesting that you shouldn't, but you need the data to back it up, because oftentimes that gut, especially when you're in a crazy environment like we're in, it's either crazy good or crazy bad. Those emotions can run wild.
Yeah, absolutely. What kind of things have you seen over the last 9-10 months since all of this has happened?
Well, we've got this 5 steps to every smart business owner should take right now webinar. And what we talk about is the first thing is you got to figure out, where are you? I've got clients that, and especially in the construction business, that are booming. I mean, it's never been better. If you're in home modeling renovation, you can't find sheetrock, you can't find workers, right? And so the demand is high, and you still got the same supply. And so, that becomes a real decision around pricing, the single most important decision every business owner will make. And if you don't really understand the cost to deliver those services, you can't make a data-driven decision about those prices. And the other extreme is people that are struggling to survive. I've got a builder in New York City who's really struggling right now, really good business, but New York's in lockdown mode and cash flow is horrible. And so now you start to look at, what's your scenario? Where are you? Are you in, I'm in a mindset of survival, and I've got to just really get my hands on the cash flow. We have a 13-week cash flow forecast that allows you to be able to see what the issues are. And Ryan is the owner in that business. He's a case study, so I can talk about it. He said, when I got that cash flow forecast, it let me sleep at night. It's the first time when my head hit the pillow, you guys sent me that cash flow, I realized, okay, it's not so bad. I mean, it's not good, don't get me wrong, but it's not like I can't make it, and I can see what I need to do, 8 weeks from now. The other scenario is, Are you in restructure mode? Okay, we're in downtime right now, but you know what? We're going to make it. Can we use this time to figure out how to pivot the business and get smarter about the business? And then the majority of our clients are actually in strengthen mode. How do we sharpen the saw? How do we automate the back office? How do we implement some of the management tools and the budgeting and the decision-making processes so that when we come out of this, we're going to be able to make more money?
Yeah, one thing you mentioned at the beginning of that is, some businesses are thriving, right? They're busier than ever, but that, in my mind, isn't necessarily a good thing unless they have the fundamentals sorted out, which it sounds like you help with, right? Because if you were struggling before and then all of a sudden you're busier than ever, but you don't really change, you didn't understand why you were struggling, that could just be making the issue worse, could it not?
Yeah, I've been a CPA advising small businesses for 36 years. And the single biggest mistake that I see is that business owners think they can sell their way to profits. And I just yesterday had a conversation with the business, 6.6 million in revenue and 2.4% profit, $150,000 of profit, split among 3 guys. And they're like, we are working way too hard for not enough money. And what I showed them was, what's your plan? It's like, we think we can continue to grow like we did last year, 10% a year. And we're putting together a 3-year scenario plan. I said, okay, so that gets you to $8 million in 3 years. But if you don't change your pricing or you don't lower your overhead, you're still going to make 2.4% profit. You're going to make $200,000 on $8 million of revenue instead of $400,000 or $500,000. So the mistake is to think growing the top line will grow the bottom line. You have to focus on the margins.
You have to focus on that bottom line first. So how would you go through? So if you started working with this company, what would be your steps? Would they be looking at the overhead? Would you be looking at price structure? Like how would you go about helping? So if somebody's listening to this right now and they're like, you know what, that sounds like me. Maybe they're doing 2 million, 3 million, I don't know. But they're like, you know what, I'm not making the money that I thought I was going to be making, or the paper says I'm making a profit, but I don't know where the profit is. It's not in my bank.
Where did the cash go is one of my favorite conversations because it's eye-opening. So I'll tell you what we did yesterday, because this is really prototypical. What we talked about first was what's reality, right? So that's your first step is, what does that data tell you, right? You have to make data-driven decisions. You have to look at reality. And what we do is we use a company scorecard that shows you a 2-year trend of the 5 most important drivers of every business. We show you your gross profit, your top line. Sorry, your gross revenue, your top line. We show you your gross profit dollars, and we show you your gross profit percentage, which to me is the most important number on every company. And then we show you your net income dollars and your net income percentage. And the focus here is looking at where are you now? What was your last 12 months actuals? And then what do you think is going to happen in the next 3 years? So there's only 3 drivers to profits. You can grow the top line, you can grow your margins, your gross profit margin, or you can lower your overhead. Most business owners know that rule, right? If you want to increase profits, there's one of 2 things you could do: increase revenue, decrease expenses, right? What we do is we say we got to separate those expenses into above the line expenses versus below the line. And let me kind of explain what that means. Above the line is gross profit, right? When somebody says above the line, they mean the costs that are included in calculating your gross profit. Your gross profit is your revenue minus the cost of goods to deliver that revenue, your cost of goods sold, your COGS.
So that's none of your expenses that it takes to run your business. Correct.
Yeah, those are only the direct expenses that the customer paid for. That without those direct expenses, you would not have earned that customer's revenue. So it's the guys, the labor, the direct labor, the guys swinging the hammers. It's the direct materials, the stuff that you had to buy to finish the job. Those are all direct expenses. Those are in cost of goods sold above the calculation for gross profit. Revenue minus cost of goods sold is gross profit. Everything else is indirect. It's overhead. It's below the line. The customer is not paying for your rent, your IT, your accountant, your HR, your lawyers. Those are all overhead expenses. And so what you've got to do is not focus on growing your top line, but, and you said it, Casey, you said it, put profits first. So what we do is we go in and we say, okay, what is your target net income? Let's start there. And these guys were like, okay, we want to make 15% profit. Fantastic. Now, the next step is to figure out how much gross profit do you need in order to make that net income? These guys needed to make 45% gross profit to make 15% net income. They're like, there's no way we're going to get 45% margins in our industry. It's not possible. They're at 33% right now. So we said, okay, if you, without lowering your overhead, we're going to come back to that as the second decision. The first decision here is how much margin do you want to make? If everything else stays the same, if your overhead stays the same, I should say, then what's more realistic gross profit percentage? They said, we think we should be at 40%. That's our industry standard. I said, okay, great. We plugged into our calculator. A 40% gross profit will net you 10% to the bottom line, 10% net income. They're like, okay, that would be great because we're $6.6 million business. That's $660,000 as opposed to 150. And so now you start to look at realism. What can we really do in our business, in our industry? And then you work backwards from there. How do you get to 40% margin? How do you get from 33% to 40? Well, you have to, what we then suggest you do is you're going to go through and calculate what is the actual gross profit on every job you've done. Now, these guys are project-based, right? They don't have any recurring revenue. So what we did was we looked at, we implemented T-Sheets, which is a time tracking system. It's magic. You pick up a phone, it has a geo solution. Your workers show up on site. It automatically pops up as they get there and say, hey, I've seen you've shown up at the Casey Gray household. You know, are you ready to start your time sheet? Yes, I am. Okay, great. What are you doing today? And it lists the services that you offer. Are you doing demo? Are you doing sheetrock? Are you doing plumbing? Are you doing electrical? And then is this a in-scope job, meaning this is part of the project, or is this a work order? Because one of the biggest mistakes that people have is time leakage, time that they're paying for, but they're not getting paid for. And so if you create a tracking system where you can say, look, if it's out of scope, if you thought you were just going to demo the walls, but all of a sudden there was asbestos up there, okay, we got to do a work order. We got a change order, right? And that additional billings is what makes or breaks you. Then once you understand the time, then what we did was we connected up his timesheets with his payroll. He was using Intuit Payroll. And so Intuit Payroll has baked into it activity-based costing, which is, you know, it's a fancy word for saying that it takes the labor costs, divides it by the number of hours that they work, and it comes up with a labor cost per hour paid. And then it magically, it's amazing that it's built into Intuit Payroll, and Insperity is a PEO. It's also automated with them. They're the only two that have it fully automated. When you run the payroll, it'll allocate the labor costs based on how people filled out the timesheets. And it'll post it back inside QuickBooks. So now you can see labor cost per customer, per job, labor cost per service that you delivered. And now you can see profitability by customer, by job, by service. And now it's magic. Now what we did was we did a report that showed you, show me the jobs. They actually had 6% of their clients they lost money on. And so the first thing we did was, okay, stop doing that. You're subsidizing. And they had a wiring project that they were bidding wrong, and they just stopped doing it. It was a special kind of in-house wiring that they just didn't know how to do. They stopped doing those works. Then what we do is we look at and we say, all right, how many jobs are you going to do in a year? And let's say it's 1,000 jobs. How much profit do you want to make? Because it's profit first. Most business owners, they figure out pricing. How much revenue am I going to get? Then what does it cost me to deliver it? Okay, that's how much I need to price. If I want to make 50% margin, I got to double my costs. We're suggesting you reverse it. You start with the bottom line. How much profit do you want to make? These guys, like, okay, we want to make a $500,000, right? 1,000 jobs. That means you need to make $500 per job. And what happens is when you start thinking that way, when the estimator comes in and says, look, this is a competitive situation here. If I can give them a 10% discount, I can close this, and then it'll help our cash flow because I'll get the deposit check and I got these workers waiting to do something, and let's just keep everybody busy. And if these guys are a good referral partner, they'll refer us to other neighbors or whatever. There's a justification for giving them a small discount. And what I find is that single decision is what causes people to have cash flow problems. It causes them to not make the profit that they want for their hard work at the end of the year. Because if you don't make 10% profit on each job, you can't make it up in volume.
Right.
So that's the first step, is what's the profit per job? And then what we do is we look and say, how much overhead do you have? You got $1 million worth of overhead? Okay, we got $1,000 worth of overhead. If you have 1,000 jobs, we have $1,000 worth of overhead that each job needs to cover. So then after looking at the jobs they actually were losing money, then we looked and says, which jobs are not covering their share of the overhead? And now you start to have a hard conversation. Are we better off being a $5 million business that's making 15% to the bottom line, or a $6 or $7 million business that's only making 5%? It's a no-brainer, right?
Yeah.
It's not how much you earn, it's how much you keep. And so you start looking at each job and your pricing model to say, here's how much we think it's going to cost us. Now, we've got to build into this $1,000 worth of overhead and $500 worth of profit in order for us to make our nut at the end of the year.
Yeah, that's so important to understand, is what jobs are working and what jobs are not working. Do more of what works and do less of what doesn't work, right? In theory, it's simple, but it's definitely hard to implement if, for example, you need the cash. You're a business, you need to close the deal because you don't know how you're going to pay your bills next month. But then what you don't realize is that you keep putting yourself into a deeper and deeper hole as the business, right? Because one thing I want to point out is one lesson that I learned a while ago after being in business is that obviously we had taken loans and we were in that same, rat race, trying to, on the wheel, and why was it not working? But I realized the other thing that doesn't pop up on those spreadsheets and the financials is principal payments to loans, right? So if you run all these numbers and you say, hey, I should have made, $10,000 last month, but you have $8,000 worth of principal payments because of loans that you tried to do to figure out everything else, it's not there anymore. Yeah. So is that something you factor in as well?
Yeah. What's the difference? Again, I hear this all the time, right? So if somebody's feeling like I made all this money, but there's no money in the bank, that's not the exception. And here's why. Because most business owners, they just look at the income statement. They never look at a balance sheet. Why? The balance sheet is hard to read unless you actually took an accounting course and you understand that, a debit versus a credit. I mean, it's just, I could see, it tells me how much cash did I have in the bank at the end of last month? How much my customers owed me, or how much I owed to my trade vendors at the end of last month, right? That's not meaningful anymore. When you finally get that report on the 15th day of the month from your CPA, and they send you an email that says, here's your income statement, your balance sheet. I mean, I didn't even open the balance sheet because it doesn't tell me anything that I can act on today. But if I open up the income statement, I can quickly see how much was my top line. And then what most of our business owners do, they jump right down to how much was the bottom line. And you can at least understand that, right? Income minus expenses equals profits. When you have profits, and you don't know where the cash is, the answer is always going to be in the balance sheet. And what we suggest to people is your balance sheet shows you what you own, which is the assets, and what you owe, your liabilities and your equity. Who owns those assets? It's either the bank owns it or the owners own it. And the first thing I like to do is I like to look at a comparison between last month's balance sheet and this month's balance sheet. So I would advise your listeners to say to your CPA, don't send me last month's balance sheet anymore. Send me last month's balance sheet side by side with the prior month's balance sheet and a column with the change. Because what happens is the profits create cash, right? Or receivables, right? So whatever profits you got, it's either going to increase your cash or it's going to increase your receivables. What happens though is that cash gets used to either pay down debt, like you mentioned, that principal payment, or to pay down on your credit cards. Another form of debt is your trade payables, or to invest in other assets like equipment, repairs, the things that you have to do with that cash. And so if you see that you have profits that the cash didn't go up as much, you look at the change in your liabilities and your assets, and that's what. How did those liabilities go down? Because cash was used to pay them off. How did those furniture and equipment go up? Because cash was used to buy them. So that's the answer that you'll always find. And one of the things that when we're suggesting that you try and figure out your pricing and look at the amount of margin that you need in order to make it, you got to look at that depreciation cost of your equipment. We were working with a construction company in Ohio, Chicken Coop Dirt Works is their name. They're another case study, so I can talk about them. And when we're doing their budgeting right now, we just finished the budget for 2021. Yes, 2 days ago. And one of the things they were asking me is like, well, do we really need to put depreciation in there? Because it's not cash, right? We don't need to factor that in. Well, first I said, what is depreciation for? Why do you have depreciation? Depreciation is the amount of expense that your assets cost you over the lifetime of the assets. If you buy a backhoe and it's I'm going to use round numbers, $100,000 backhoe, and it's going to last you for 5 years, you're going to record a depreciation expense of $20,000, or I was going to say $100,000 every year. That's an expense. They were trying to say we should take that out of the budget and the bonus calculation because it's a fake expense in their mind. It's not really cash. What I said was the purpose of that expense is you need to generate another $100,000 in cash so that when you replace the backhoe in 4 years, you've built up enough cash that you can afford to do that. And your margins have to cover the replacement cost of those assets. And so that's another big mistake that people make is they're looking at their pricing and saying, okay, I made a profit, but then I had to use that cash to buy a piece of equipment. And I'm wondering why I don't have any cash in the bank because we didn't sock that depreciation away for a rainy day.
Right. So they weren't putting it separately. So one word you keep mentioning is margin, which I know what it is, but I didn't at the beginning. Right. And there's a difference between margin and markup. And, if somebody wants to make, for example, you're throwing the number around, 10%, 15%. And obviously we're trying to go through a few quick points here, but I would like to touch on the difference between a margin and a markup. And if somebody thinks that they need to make 20%, it's more than just marking things up by 20%.
Yeah. So let's use a simple example. I have another case study. I love telling the stories of our clients, and I'm so happy with the ones that are willing to let us share their information. Liberty Pipeline is a construction company in Houston, Texas, that did pipeline. And these guys were really smart. They were out of Enron, and they were the smartest guys in the room. They were when Enron collapsed, they actually had a real business building pipelines. And so Alan Weatherford, who was the CEO, he thought I'll sell my way to profits, and he did his pricing based on a markup. And he said, it's 20% margin is the industry standard. So he looked at this and said, okay, if I'm going to pay somebody $100,000 salary and I want to make 20%, I need to mark them up by 20%. And he made two mistakes. And this is common, right? This is not like rare. The first mistake he made was he just looked at salaries. You have to look at the fully loaded labor costs. You have to look at the taxes, the health insurance, the 401k if you're offering one. It costs you money to recruit and train people. You've got to look at all that. Whatever the fully loaded costs are. He had 28% fringe cost, burden cost, we call it, right? Fully loaded. He didn't have a $100,000 cost. He had a $128,000 cost. And so when he was marking that up by 20% and billing that out to try and make 120,000, he was losing money because those were real costs. He had to pay the taxes. He was covering people's health insurance. He had experienced, senior managers that he had a 401k so that he could keep them. The second thing he did is he didn't realize that there's a difference between taking 100 and marking it up to 120, between that and saying, okay, if I want to make 20%, if you have it at 120 and you take 20% of that, that's $24,000. You're only making 96. You're not making the full 20%. So you got to look at you got to look at your revenue and calculate the cost off of that. You can't look at your expenses and add to it.
Yeah, you go backwards in a sense, right? So it's your total top line and you go backwards as opposed to taking the expenses and adding onto it. So
yeah,
such a key. I think it's a difference, like on the quick math, like if you were to mark something up 20%, you actually only make like 16.7% margin or something like that.
Yeah, exactly.
If you had his expenses right in this case, right? So
right. And here's the other big thing that we see a lot of. We helped Alan. He went from break even. He was using a factor to pay payroll. He was really struggling. He tried everything. He did the classic things that you would expect in a business that was really smart. He's like, okay, I'm going to grow my way to profits. He added new product lines. He opened up in different cities. He actually said, okay, I got to change the business model. He took some software that they had developed for their own delivery to the clients, and he turned it into a different profit center, and he spent some money building software thinking that will be more profitable. His biggest challenge was, when you make money on people's time, is you've really got to have visibility into the real time it takes to do the work. And what we find is a lot of businesses have tremendous time leakage. Time you're paying for, but you're not getting paid for. What does that mean? It's the project managers. You got to have a project manager, right? In order to really manage the project. And if in Alan's case, he had those costs below the line in overhead. Why? Because they were called managers. Management is overhead, right? No, you can't. The above the line costs are the direct costs that the customer directly paid for. And if you can't do the job without that person, it's above the line. It's direct. You can't do the job without a project manager. So we moved those into his bid. We also found that there was 20%, and this is typically what I see. There's about 20% of time that's the hidden cost of the job. It's the client interaction. It's the phone calls, the emails. It's the quality control. Hey, boss, I got a problem here. I don't know whether or not we should. Okay, well, that takes time. And, when you put the bid together, it's rarely green lights to the airport. So you got to count for that red or yellow light and an occasional flat tire. And so what we encourage our clients to do is to be able to go in and add a line that says project management, quality control, and client interaction. And it's just 20%. And especially if you're busy, because supply and demand is a magical force. If you are in a position where right now you have more work than you can handle, you have a shortage of laborers, or you have a shortage of sheetrock, because nobody can find sheetrock in the last 6 months, it seems, then that is the time for you to be able to speak with confidence about what you're worth, and to recognize that if you don't bill for the value that you're really delivering, for that project managers, for the quality control, for the actual time that you spend making sure the client is happy, you're never going to get to your profitability margins, because that's a real cost of business that most people forget.
So you said it was 20% for quality control, client management, and what? Sorry?
Client interaction and project management.
Oh, project management, client interaction.
Yeah, that's just a generic.
Yeah.
You can call it whatever you want. But the point I'm trying to make is, when you do your pricing, you've got to put in there the hidden costs of the job, the time leakage, the emails that you have back and forth, or the phone calls, or just the extra on-site that you've got to do. Because it's not just the obvious tasks, it's the time leakage, it's the hidden costs that you have to include.
Yeah, absolutely. One of the things that we've started to implement here, big thanks to my brother and partner, Chad, who's an engineer. So he loves numbers. He loves figuring out what's working, what's not working, the processes, and hence why he's helping out so much. But we've started measuring the billable time, like actually analyzing it and figuring out the efficiency of all of our guys on site. Right. So how much time are they putting in? It's easy, right? We know what their hours are. We don't use timesheets, but we use something similar. And they can see where they're working, and we know how much of that is billable. So, okay, well, we have a target of how much of their time we want or need billable. And if we're not hitting that, why, right? And what do we need to do to change? So, but once again, time consuming, easier said than done. It needs to be implemented at some point, and somebody needs to do it.
Well, if it's automated, it's actually pretty efficient, right? That's where T-Sheets comes in. There's a bunch of time tracking systems that are all on the phone that'll sync with QuickBooks. QuickBooks has 88% market share for a reason, right? Mm-hmm. Everybody has synced with their tools. So, but you want to look at what you just talked about there was called utilization rate, right? What's the percentage of time that's being billed to billable work or chargeable work? If you have fixed fees, you're not billing by the hour. We call it chargeable work. What does that mean? It means that you're actually you're earning revenue, right? They're income generating time versus, time in meetings, or if you got a training, or if you got to, travel that's not actually on site that you're getting paid for. You want to look at that utilization. Not every hour is going to get billable to a job, but when you're trying to figure out your rates per hour, you calculate, how much profit per hour or how much overhead per hour do you have to cover, you only want to look at the chargeable percentage. So like, there's 2,000 hours in a year, round number, right? 2080. If you're saying, okay, I want my people to be 80% billable, that means there's only 1,600 hours that you can use to recapture that. So when you divide your profit by the number of hours to come up with a profit per hour, you only do the chargeable hours, the 1,600, because those are the only hours that you can make the $50, the $500 profit, or the $50 profit on. Does that make sense?
Yeah, absolutely. Totally makes sense. Okay. So we could obviously talk on all sorts of different things and keep going here for like probably another few hours. We'll have to have you back to dig into some of these other notes that I had, but I do want to go back to something that you mentioned at the beginning, which is the 5 smart steps to take right now, like for 2021. Yeah. Would you mind going through those 5 steps with us?
Riff on that for a second?
Yeah, that'd be great.
The first is the right mindset, right? You can't have a feeling of fear. That's the single biggest mistake that I have. If you have fear, you're going to give that 10% discount. You're worried about, can I make it? Can I survive? I got to get the next job because I got people waiting to work. You have to shift that to abundance. You have to have a mindset of, whatever I'm blessed to have, let me have that as my guiding force, because that's the difference between the companies that are successful and living the dream and those that fail. Is if you start from a position of fear, it's going to become a self-fulfilling prophecy. So how you do that is to get the data. You have to have a mindset of, I know exactly what my cash flow is. I know exactly what my break-even point is. And I can see different scenarios. In survival mode, this is what it looks like. In restructure mode, this is what it looks like. And then if I'm in strengthening mode, this is what it looks like. And have an ability to figure out where you are and start from there. Then the second thing is you have to be vigilant about cash flow. We've got a whole webinar on this, getting stronger through these 5 steps. Cash flow is about timing of money in and money out. There's some best practices that everybody should have. The first is have that 13-week cash flow forecast. It's a requirement, because if you don't see the numbers, the 3 reasons why businesses fail is because of cash flow, and cash flow. And this will help you sleep at night and not start from a position of fear. We also have a bunch of best practices on collections and getting the timing of when you get paid versus when you have to get payroll. automating your billing and collections through credit cards and all that kind of stuff is all in that step 2. Step 3 is figuring out your below the line costs. You want to cut your overhead. You want to automate as much as you can in the back office. I mentioned automating the billing and the collections. The entire bookkeeping process, according to the AICPA, which is the American Institute of Certified Public Accountants, the highest body in the land, they've got this technology group who said the entire bookkeeping function will be completely automated by 2025. And then after the pandemic came in the last year, they said that's actually being accelerated by maybe as much as 2 years. So by the next 3 years, the entire billing, collections, bill payment, all your payments, we recommend bill.com to pay your bills. If you're signing checks, you should immediately go to bill.com and sign up, because you get your bill payment on your phone, similar to your bank, except you have scanned images of the bills attached. So you can make sure that the office manager is not trying to sneak in their own credit card bill. We should do a whole nother session on fraud, because desperate times create desperate measures. And we're seeing a lot of fraud happening right now. Bill.com helps you not only see that scan image to prevent the risk of fraud, but unlike the bank, it has workflow. So a budget manager can approve it before you sign it. And it's automatically synced with QuickBooks. So as soon as the bill gets entered, payables is updated. As soon as the bill gets paid, your bank is updated. And so there's a lot of best practices there that you can cut your overhead costs, cut your accounting costs, and your HR costs, and anything that you can that's not direct, that's below the line. So that's step 3. And there's a bunch of reports that will help you look at that. Step 4 is review your above the line people and study who are the people that contribute the most to profits. Who are the ones that you just can't afford to lose? And then, who are the people who you should either coach them up and train them up or out, and replace a C player with an A player, because it's people that drive profits. If you've got a great foreman who's got a great team, study the behaviors of that, and then use that to recruit your next team. And we have found that on average, in American businesses, the average employee wastes 2 hours every day. This is a study that's been made. I didn't just make that up. Salary.com did the study. And 15 minutes a day is 3% of the work week. On a 40-hour work week, it's an hour and a quarter. So if you're a $100,000 business, 3% if you're a $3 million business, 3% is $100,000. So if you can get some additional productivity out of your people by putting in place, treating them like an asset, investing in their training, and rewarding and recognizing the people who really do you a good job. There's a whole study of Maslow that people need recognition and reward more than they need anything else. So, that human capital strategy, where Insperity comes in, they're a partner of ours, they do the outsourced HR, talks about which people drive your profits and how do you study them and how do you get more like them. So that's step 4. And then step 5 is get back on offense. Once you've got the data, once you really have a plan, then how do you sharpen the saw, right? What's your big, hairy, audacious goal? And what's stopping you from getting there? Harvard did a landmark case study where they said the simple act of writing down goals will increase your likelihood of success by 82%. Why? Because, again, it comes back to Maslow in an interesting way. We all have a need to belong to something bigger than ourselves. So if you can get people to understand what success in the company is and what their role is in the success in the company, and then why that's good for them and their family, you're going to get them to start acting like owners. You're going to start to get discretionary effort. And when you get that discretionary effort, you transform the whole organization. Because if you look at the companies that are wildly successful, they have profit sharing. People share in that success. And once you start to match the financial management strategy with the human capital strategy, now you are able to knock it out of the water. So that's kind of the 5 steps in a nutshell.
Yeah, no, that's great. Those are good places to start for people too. Give them something about the type of stuff that you work on within your business and what you focus on. It's really nice to hear where you start with is that mindset, because that in my opinion, is the most important thing for everything, really, but especially in business as an entrepreneur, right? You need to be able to, like when the pandemic hit, if your mindset wasn't good, it was just going to make it worse. For myself, I feel like I had spent the last 10 years building up to this point, and I was actually in a really good mindset. And I was like, this is great. Like, I feel like I've been preparing for this my whole business career. Right. But I was lucky enough to have focused on personal development throughout those years. So
good. Yeah, it's great.
So this has been a really long, good, information-packed session. So I really appreciate it. We'll have to have you on for sure, because there are a couple of things that we want to touch on. But to close this off, any last parting words of advice, or what's the best way for people to get a hold of you?
So I think the most important decision every business will make is pricing. And so if you took one thing away from today, it's, you have to have real visibility into those above the line costs, the real cost to serve your customer, and work backwards from the profit in mind. If you put profit first, you're not going to give that discount when the sales rep comes in. Now, I'm not saying you should never give a discount. I don't want people to walk away from that. What I'm suggesting is you should make a data-driven decision about a discount, and knowing that if somebody comes in and says, I want to give a 10% discount, and you say, okay, well, that's a $50,000 job, and that's $5,000, all of that discount comes out of your profits. Nothing else changes. So if you're not making your profits, it's always, or if you have cash flow problems, it's always because you're not charging enough to get the profits you want. And so, I'd love to come back on and talk about how do you increase your prices in a tough market. And the successful companies understand their value because they can see that above the line cost, and they can get their salespeople to explain why they're different.
Yeah. And the best way for people to get a hold of you, or if you want to share a few places?
Sure. Yeah. Email is the best way to reach me, and I'm always happy to answer questions. This is fun for me. It's Stephen with a PH, STEPHEN @growthforce.com. That's GROWTH force.com. On our website, we've got a link to our new webinar that we just launched, which is the 5 steps every smart business owner needs to take right now. And that's growthforce.com to sign up for the webinar. And I'm on LinkedIn, Stephen King, CPA. We'll
be sure to share all those links. Once again, Stephen, thanks so much for coming on, sharing your wisdom with us. I hope I got a ton of notes here of things that I want to make sure that we're doing. So I appreciate it. And I hope everyone listening or watching has the same. So thanks again. Till next time.